Mega cap tech, Tesla's post-earnings drop weighing heavily on the S&P 500, down about 0.75%, which brings us to our talk of the tape. Should investors take heart in Powell's wait-and-see approach and a so far encouraging earnings outlook, or are long-term yields flashing a yellow light for risk? Let's ask Anastasia Amoroso, Chief Investment Officer at iCapital, joins me here at Post 9. Good to see you.
Good to see you, Mike.
Plenty going on. As we just kind of ran through, the bond market is still fixated on perhaps the supply of treasuries at the long end, perhaps the lack of buyers that have shown up so far, and it's gotten people skittish. Is that really what's driving things right here? Can we get some clearance from the bond market to refocus on earnings anytime soon? Yeah,
I mean, unfortunately not yet, or at least not today. And, you know, if you think about what's driving these yields, I mean, it's at least 3 or 4 different factors. You know, first of all, you've got growth that remains resilient, so that keeps pushing up the long end of the curve. Then you've got inflation, you've got oil that's a little bit more resilient, and so that feeds into policy, so the markets are pricing that in, and inflation break-evens are staying sticky. And then Fed policy, you know, today, you know, it was sort of, we're going to move carefully, but at the same time, maybe we're not yet done. So you put all those factors together, and that's what's pushing up the yields. But then that doesn't explain the whole move that we've had in the last 2 months. And, you know, there's a big residual there. And I think that has squarely to do with this very different environment today, which is this is not QE. This is quantitative tightening at the time where we're issuing record amount of treasuries and refinancing about 40% of our debt maturities this year and next. That is what really pushing on the yield curve and pushing those yields higher.
Does that mean that, you know, you just have to sit back and see where yields ultimately settle out, or are things becoming interesting and cheap along the way? I mean, the S&P 500, you look at it, you say, been pretty resilient, all things considered. It's been in this tight range, still up, you know, 12 or so percent on a year-to-date basis. But we all know the average stock's done nothing this year.
Right.
And only about maybe a third of S&P stocks are up 10% on the year. So how do you navigate it?
Right. Well, I think if you look under the hood, the market has actually been incredibly resilient, and I would say discerning, I mean, amidst this higher rates. And, you know, what I mean by that, you know, this month we've got 36 basis points or more of backup in yields. And at the same time, the S&P, well, maybe until today, was sort of in positive territory. And the NASDAQ has been outperforming. Software was up 5% before the sell-off that we had. So that's a lot of resiliency. And also, you know, if you fast kind of rewind back to the last month, we had 115 basis point backup in rates. And you would think the market would be down 10 or 50% or more. Big tech is down about 6%. So I think that's kind of remarkable resiliency. So what the market is doing is being discerning. If you think about big tech, it's actually one of the sectors that is most immune, so to speak, fundamentally from higher rates. Yes, higher rates hurt valuations, but at the same time, tech doesn't have a whole lot of debt on the balance sheet. So what I worry about, and I think what the markets worry about, are the sectors in the economy that do have a lot of debt, that are vulnerable, and, you know, consumer discretionary, for example, case in point, unprofitable tech, those are taking it on the chin, and, you know, rightfully so.
It is true, but, you know, those exactly are the areas that you would say yields have registered. The idea of a slowdown that might be coming is already making its way into those valuations. So again, you have this bifurcated market and are left with saying either market's got it right and we should just follow the trend, or we want to be somewhat counter the tide and try to look for stuff.
Well, I love to be a contrarian in most cases, but I think in this case the market is actually right. And the reason is I can't say with certainty that we have reached a peak on a 10-year treasury. Yeah. And again, the reason I say that is because when we look at the different kind of, you know, debt piles around there, you know, we know there's so much treasury debt that is coming due. Again, 40% of those maturities are due this year and next, and they have to be refinanced at materially higher rates. And by the way, this is happening at the time where the Fed used to sit on about a 25% treasury of outstanding that was out of the market. That's not the case today. That percentage down to 19%. So the Fed is not an incremental buyer. The central banks globally are not. The banks are not buyers of these treasuries either. So that really leaves us with a supply and demand mismatch. So that means most likely we can't quite call a cap in yield just yet. And so that's what makes unprofitable tech a challenging place to buy the dip in, as well as consumer discretionary.